Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Europe podcast, available every morning on Apple, Spotify or wherever you listen. It's Friday, the 20th of September in London. I'm Caroline Hepker.
And I'm Tom McKenzie. Coming up today, UK national debt tops 100% of GDP for the first time since 1961 as government borrowing overshoots.
Family firms tell Bloomberg a UK inheritance tax hike would destroy them as consumer confidence dives on budget belt-tightening fears.
Plus, to have and to hold, the Bank of Japan leaves rates unchanged as the central bank signals it is in no hurry to hike again.
Let's start with a roundup of our top stories.
UK national debt has hit 100% of GDP for the first time since 1961 on a sustained basis. Government borrowing came in higher than forecast in the first 5 months of the fiscal year. The deficit topped £64 billion between April and August. That is £6.3 billion more than expected back in March. The figures are the penultimate snapshot of public finances before the Chancellor, Rachel Reeves, delivers the first budget of the new Labour government at the end of next month. Reeves has previously warned of painful choices in the budget after accusing the previous Conservative government of leaving a £22 billion fiscal hole.
Well, sticking with the economic data for the UK, retail sales picked up in August, with online and in-store sales rising by 1% in August, data out this morning. But consumer confidence crashed in September amid dire warnings from the new Labour government about those tough choices that need to be taken to fix the public finances. Research firm GfK said its monthly confidence index fell 7 points to -20. Last week, the former Bank of England chief economist Andy Haldane called some of the government's rhetoric unnecessary, unhelpful and a bad idea.
It'd be much better to say nothing until you provide solutions to filling the black hole as well as revealing it. As it was, that's generated fear and foreboding.
Andy Haldane's comments chime with new reporting from Bloomberg that has found small and medium-sized business owners are increasingly fearful over reports that the new Labour government could end business exemptions to inheritance tax.
Despite that, the Bank of England says it will not rush to ease monetary policy after leaving rates on hold yesterday. Governor Andrew Bailey says he's still concerned about services inflation.
Our job is to make sure that inflation is sustainably at the 2% target. There are still some pressures. We've seen services inflation is still elevated. So I think interest rates are going to come down. I'm optimistic on that front, but we do need to see some more evidence. And of course, we will be looking at this at every meeting.
Bailey's comments sent the pound to a 2-year high against the dollar. The central bank also maintained its quantitative tightening plans. This would give Chancellor Rachel Reeves up to an extra £4 billion of much-needed fiscal headroom in her upcoming budgets.
Now to the Bank of Japan, which has left its key interest rate unchanged today, signalling that it sees no need to hurry with hikes after its July increase spooked investors. In his press conference, Governor Ueda said that there is no change in the Bank of Japan's plan to raise rates if data stays on track towards stable inflation. About 70% of economists surveyed by Bloomberg expect another increase by December. Garfield Reynolds, who leads Bloomberg's Markets Live team in Asia, gave us his analysis of the decision.
There were hints that there could be some more hawkishness, or at least some justification for hawkishness, because the BOJ sounded more optimistic about the economy. It raised its assessment for consumer spending. It sees inflation expectations moving higher in the medium term. All of that is the sort of thing that would set them up to consider rate hikes going forward.
Garfield Reynolds speaking there. The Bank of Japan's two-day meeting kicked off hours after the Federal Reserve conducted a long-awaited policy pivot with a half-point rate cut. That move drove the S&P 500 to a new record high yesterday as jobs data backed the view that the US economy is headed for a soft landing.
France's Prime Minister says he will announce the makeup of his new government by Sunday. Michel Barnier met President Macron yesterday evening for what his office described as constructive talks, during which he outlined a list of ministers. Stéphanie Yon-Courtin, who's an MEP for Macron's party, says the new cabinet will have to make important decisions for the country's future.
I mean, it's a really hard task, I know, for the new Prime Minister. And I hope everybody will be, on board and responsible to make sure that we find, at the end of the day, the right method to enter into a more reasonable budget for France and for Europe as well.
Stephanie Yoncourtas speaking there to Bloomberg Television. Reports in the French media say the new team will largely be made up of figures from Macron's centrist group and Barnier's Conservative Republicans Party.
Now, Germany may only see a return to economic growth later this year. That's according to a new Bloomberg survey of economists. The country has been under the spotlight after growth fell behind European peers. Bloomberg's Tiwa Adebayo has the story.
A recession will be narrowly avoided in Germany, where growth will only kick in towards the end of the year. That's according to economists polled by Bloomberg, who now forecast stagnation in the 3 months through September, compared with a previous prediction of 0.2% growth. The expectations are broadly in line with the view of Bundesbank, who said this week that German output could stagnate or decline again in the third quarter. Despite the dim prognosis, those surveyed still expect Germany's end-of-year rebound to be sustained into 2025. In London, Tiwa Adebayo, Bloomberg Radio.
Now, staying on Germany and focused on one of its big corporate players, particularly within the auto space as well. Mercedes-Benz overnight coming through with a downgrade to its outlook. And you can see the shares right now, one of the biggest losers on the European Stock 600, currently down 6% on Mercedes. Again, they lowered their outlook with a particular line on China. So they are feeling the pressure as Chinese consumers cut back on their purchases of those premium vehicles. Mercedes-Benz taking a knock as they lower their expectations in terms of returns in the main cars unit, now expected between 7.5 and 8.5%. That compared to a prior forecast of 11%. The stock down 6.2%.
Now, Israel says that it has struck hundreds of Hezbollah targets in Lebanon, including scores of rocket launchers. It comes after the leader of the militant group vowed to inflict a just punishment after walkie-talkies and pagers exploded in coordinated attacks. 37 people died and more than 3,000 people were injured. The UK's Foreign Secretary David Lammy is urging both sides to come to the table and negotiate.
We are all very, very clear that we want to see a negotiated settlement so that Israelis can return to their homes and indeed Lebanese can return to their homes.
Despite David Lammy's urge for calm, an imminent ceasefire looks unlikely. While there are few signs an invasion of Lebanon is imminent, Israeli officials have said that diplomacy with Hezbollah is failing. In a moment, we are going to bring you more details on the UK's national debt picture. It's a number, it's a round number, 100% of GDP. What does it actually mean? Well, we're going to bring in Bloomberg's chief UK economist, Dan Hanson, who better to give you an understanding of why that ratio is important to economists and also in the immediate what it means for the budget in this UK government. That in just a moment. But there's also a really great piece on the Bloomberg Terminal that has caught my eye. Nice photographs, lots of background, of course, on the US presidential race. What would happen if Kamala Harris actually wins, not just in terms of her personality and the change in tone that she has campaigned on, that if she were to win, she would be a sort of change in terms of the personality leading the US and would be a contrast to Donald Trump, as she has advocated, but actually what she would do in terms of the policy, taxes, tariffs and so on. There is a debate about how tough she would be, given her background, in terms of regulation and taxation in the US. I think it's a really great piece on the Terminal, well worth reading.
There was also the event she did last night, overnight, with some celebrities, with Oprah Winfrey, and it was quite revealing, actually, some of the video clips of that. She seemed to open up, as ever, Oprah Winfrey, managing to get her interviewee to kind of open up more than they might otherwise. And she came out with a line on being a gun owner and saying that if you were to try and break into my house, you would be shot. And then she said, I should probably get into trouble. I probably shouldn't have said that. But she seemed to come across but kind of much more open, fielding questions from the audience, fielding questions from those who were dialing as well. Talked about immigration, talked about gun rights, talked about abortion. It's pretty interesting sit down with Oprah, who of course has come out, here's the context, in terms of in support and giving her back to Harris at this point.
Absolutely. And the criticism of Harris has been that she has sort of campaigned essentially as a kind of front runner in a way, whilst doing and therefore doing very few sort of forensic interviews. And so that was also the context of that. Yeah, quite interesting. Anyway, it's on the Bloomberg terminal this morning in terms of Kamala Harris and the analysis of what she would potentially do if she were to win the race to the White House. Right, that's one story. Let's also talk about the UK's national debt picture, which has now hit 100% of GDP as government borrowing came in higher than forecast in the first 5 months of the fiscal year. This is data that just came out this morning. It also comes as consumer confidence crashed in September amid these dire warnings from the new Labour government about tough decisions that need to be taken to fix the public finances. Bloomberg's chief UK economist Dan Hansen is in the studio with us. Very good morning to you, Dan. So firstly on the deficit, I mean, you've worked in Treasury in the past, you with deep knowledge of this. Just explain to the audience why 100%, that ratio, why is that important? What does it mean in economic terms?
Well, it's sort of, there are two numbers that make it up. There's the top number, which is the amount of debt, the cash value of the debt the government has, and the bottom number is how much income. So GDP is the economy's income. So it's a measure of affordability of that debt. So how much income we have to service that debt, and obviously it's very striking, 100%. It's extremely high. I mean, one thing I'd say is these numbers are very much prone to revision. Mm-hmm. And actually, it's the 100% of GDP isn't the metric that there are various metrics of debt that are used, and it's not the metric that the government target, at least at the moment, in its fiscal target. But nonetheless, you're right, it is quite a startling number. I mean, I think the interesting thing for me from the data this morning is that the story since the sort of start of the year, and we've spoken about this a lot, is that the economy has done a lot better than everyone's been expecting. But actually that hasn't translated into the deficit falling faster than expected. And you would expect it to, because if there's more economic activity, that means more tax receipts, and you'd expect the deficit to fall faster. But actually what's been happening is that deficit's been falling more slowly than expected. And that's, if you look at it relative to what the OBR was expecting, a lot of this is to do with departmental spending and to do with public sector pay awards, which is interesting, of course, because that's where at least part of the black hole that Rachel Reeves uncovered was to do with public sector pay and the fact that she's awarded a big public sector pay boost at the end of July. So you sort of got this question now about is departmental spending going to track well above the OBR's forecast, at least in the near term, and therefore is the deficit going to continue to sort of come down but slower than expected? Dan,
is 100% debt to GDP for the UK the new normal? Is it the floor? And how do markets react to this? Gilt markets seem to be relatively relaxed about that round number in the session today. But that's the challenge, isn't it? That international investors turn around and say, we're not quite sure you're going to be able to pay your debts back.
Yeah, that's always the concern. And you when there is a concern about that, there is obviously a very sharp market reaction. Go back to 2022. That's sort of a classic example of that. I would say that the UK is just, I think the key point for investors is the UK is not an outlier. Like all countries have this problem. I mean, if you look at, for example, in the US, it's far worse. The fiscal
123% debt to GDP, according to BlackRock.
In the US, yeah, and the picture as well is far more concerning. You know, running a 6%, 7% of GDP deficit means that the path of debt is much more explosive, and in Europe too. I mean, the general challenge across all economies is that we have, probably apart from the US, but certainly in Europe, is very slow nominal GDP growth and high interest rates. So that means you have to run a very tight fiscal stance in order to bring debt down. And I think there is this question for investors now in this higher interest rate environment. Are we just going to live in a world where debt, as Tom says, stays at these levels, perhaps just creeps up over the course of time? There's always going to be this commitment to bring it down, but because these targets are in the future, they never really bind. So you always have this slippage. Yeah,
2 points I'd make about that. I mean, the US operates the world's reserve currency, has the biggest, most liquid market. So in some ways, maybe it's, the outline and the growth is strong and so on. Also, the other argument that I've heard about that is that the UK is not an outlier at the moment. But if things were to change, let's say, to its other peers in Europe, then that would be the point at which it might become problematic. An argument that I've heard. But the other issue is also what this spending now means more immediately for the 30th of October.
Yep.
So your thoughts around the budget and what the government's thinking?
Just on the
pushback.
one of those. No. I think I agree with the point about the US. It probably has a sort of slightly different, held in a slightly different regard by investors. Sure. Europe, it feels to me, at least UK relative to Europe, there's just a lot more political capital behind fiscal, sorting out the fiscal position. In Europe, it just seems to slip. It's constantly slipping. The plans get pushed back. I feel in the UK, there is this commitment to it. It's very difficult. Like, we know it's difficult, and coming onto the budget now, we can talk about that. But I feel like there is a political will to get the public finances, or at least look like you're trying to get the public finances sorted. In terms of what all of this means for the budget, we saw the consumer confidence numbers this morning. There appears to be sort of a sentiment shift because of what's been said around this budget. I'd make one. I think there's a really important point to make about this, is that Rachel Reeves has been talking about all these black holes, and it's about what she's talking about is finding taxes to fill these black holes. But that black hole is higher spending. So on the one hand, you've got higher spending, and on the other hand, you've got higher tax. So it's giving with one hand and taking with the other. So people, and of course, across the population, people will feel that differently.
Yeah.
Not everyone will benefit from the spending. Not anyone will have money taken away from them in terms of tax. But if you're looking at it from a macro perspective, which, if you're thinking about the Bank of England, for example, there are these two sides of the sort of ledger, if you like. There is spending and tax.
Dan, why is the BOE sitting on the sidelines? Growth is stagnating. The consumer's feeling crushed. We saw that in the survey today. We're going to get tax hikes in the budget in October. The idea that there's a myopic focus on services and where's the rest of the inflation going to come from? Oil prices are soft. Is the BOE at risk of a policy mistake?
I don't think that. To be honest, I sort of take the other side of that. I think what's going on, this idea that it happened at the start of the year, right? Everyone, what was it, seven cuts over the course of 2024 that was being priced. I think for the bank it was 5 or 6, and we thought we sort of bought into that. We did think inflation would fall sharply, particularly services inflation. And you're right, there is this what might be considered myopic view of that, until services inflation hits this number, I'm not going to do anything, which is sort of how you feel when you watch the bank. They're so obsessed with it. I do think that the experience of the past 18 to 24 months tells us that I think they're right to err on the side of caution. You're right, growth stagnating, but actually, relative to what you might have expected from a 500 basis point interest rate rise, that's not too bad. You'd have expected a pretty deep recession if you'd sat here in 2021 and told me they're going to raise interest rates by 500 basis points, what's going to happen to the economy? I'd have said, well, we're heading for a really deep recession. And that would have been completely wrong. So the story that there are these points about the US labour market and the like, but I think the story over the past 18 to 24 months is economies have held up remarkably well in the face of this tightening cycle. It might be that neutral rate, sort of the long-term rate that interest rates settle at, is higher. So I think as you cut, you just need to be a little bit cognizant of that. And from the bank's perspective as well, the final point I'd make is that their mandate is inflation. The Fed's mandate is a dual mandate.
Yeah.
And that 100% gives them more flexibility. They can just shift their focus, whereas the bank cannot shift its focus off of inflation. It's just not allowed to in terms of its mandate, whereas the Fed can shift.
Maybe it's time for a new mandate for the BOE.
Yeah, that raises that issue, right? That this is very much
that's going up. People are not feeling flush.
No, they're not. No, and I agree with you that in the past, it has felt like the bank has got more of a dual mandate. If there were signs of weakness in the labour market, it would be very much the focus. I think another lesson, sitting here giving lessons, another lesson of the past 18 to 24 months is that inflation expectations aren't that well anchored, so they can't look through these inflation shocks all the time. And so it means that inflation does become very paramount. And when you do get these shocks, you do have to respond and not just look through them. So There's a lot for the bank to consider. I think they were probably right to hold yesterday. I do think the risk is they speed up later in the year for what it's worth and into 2025.
Now, we just played a little bit earlier on the programme the clip from the former Bank of England chief economist Andy Haldane about his criticism of the rhetoric from government being a bad idea and unhelpful, and that you need to fill the kind of black hole of public finances before you kind of spook people about it. Which brings me on to some exclusive Bloomberg reporting from family firms in the UK, SMEs, small and medium-sized businesses, who are worried, according to what they've told us, about whether there are going to be changes to the exemption to inheritance tax for businesses that get passed on, through the generations. How likely is that in terms of the budget, the IHT changes? What are you thinking about? Just give us a quick runners and riders of the tax changes that you think are going to be coming potentially.
Yeah, I think, they basically, Labour have boxed themselves into a corner because they've said no rise in income tax, no rise in national insurance, no rise in corporation tax, no rise in VAT. So that doesn't leave you with a huge amount. So IHT is one. I think it's very likely. I mean, the thing with it is it doesn't raise a huge amount of money. When you're talking about £20 billion black holes, changes to IHT might get you 1.5, 2 max if you do something, and that requires you to do something quite significant as well. The other one is CGT. That I think there's
capital gains tax.
Capital gains tax. Yes. There are various things that can be done there. The most most high profile of which is bringing it the rates in line with income tax. And the final one is pensions and how pensions are taxed in terms of, first of all, we get, there's a lot of tax relief on private pension contributions. On the income tax side, but also on the national insurance side, employer national insurance side as well. So that's one I think that's gonna some combination of those three moves will be the sort of where I think the bulk of the money comes from. They'll be tinkering around the edges as well on other taxes, but that's where the money will come from.
Okay, putting it into clear focus for us, 30th of October. Dan, thank you so much for being with us this morning. Bloomberg's chief UK economist, Dan Hansen. Then the UK's national debt hitting 100% of GDP, the main headline.
Now from the UK to Japan. The Bank of Japan has held rates steady and signalled it sees no need to hurry with interest rate hikes. Governor Ueda emphasised patience in the post-meeting press conference. That's after a week of central bank decisions that, of course, saw, as we discussed, the Bank of England hold and the Fed cut by 50 basis points. Let's bring at this point then Bloomberg's Europe FX and rates editor Aline Oimada, who would have been very busy indeed this week. Aline, talk to us about the BOJ decision to hold, fully expected by the economists. Did we get any clarity on the steps ahead for the Central Bank of Japan in the press conference?
Yeah, Ueda wasn't decisive on the press conference, but he did say that upside inflation risks are receding. And that was probably the most important part of the press conference so far, because the market saw that as a message that they are not in a rush to hike rates. He did leave the room open for more policy moves this year, and the market expectations continues to be one more hike in December. But overall, what we got was a very balanced message that this is not guaranteed at all.
It was also interesting, Aline, what he talked about when it comes to the US economy, that the economy there has become a little harder to read. I thought that was quite an interesting line from the press conference, obviously, after the Federal Reserve meeting.
Yeah, absolutely. I think the U.S. economy has been one risk that they have been flagging for the Japanese economy for a while now. And what the Fed does obviously impacts them. At some point of the conference, it almost felt like he was kind of criticizing the 50 basis point move. But it's definitely something that will impact what they will do next. Let's remind that after the August turmoil, they said they wouldn't want to hike rates in a very volatile environment, and that obviously could be caused by U.S. policy. So I think both central banks will have to be kind of intertwined in what they do next.
We've just been discussing the fortunes or lack of fortunes of the UK economy. Aline, when it comes to how the markets are adjusting to the view around the Bank of England after the central bank here decided to keep rates on hold, how has that picture evolved? What does it tell us about the outlook for interest rates here in the UK?
Yeah, so traders saw the announcement yesterday as slightly hawkish. They did say that they will be gradual in cutting rates, and that coming after a big move from the Fed, that felt very hawkish. So we saw some adjustment in the rate cuts expected for this year. Before the meeting, it was 2 more cuts in November and December that were fully priced. Now the second one, it's not hanging in the balance. I think the market is still favoring one in December, but there's a smaller chance of that happening. I think the big adjustment from now on from the Bank of England will be, will they do quarterly cuts, or will they cut every meeting starting later this year? And like Dan said earlier, they are really erring on the side of caution, and maybe reasonably so. But there is some fear that later on they will have to play catch up and accelerate.
Just conclude this week, would you, in terms of what this means for Europe, the move from the Fed and what has flowed from what was a very busy 36 hours of rate decisions. What's the thinking now at the end of this week in terms of bond markets as we go into year end? You know, the Fed trajectory is crucial, but what do you think is the big takeaway for markets at the end of this week?
You know, one thing that is interesting is that if you look at the amount of rate cut expected from major central banks, it didn't really change that much this week, which is kind of surprising because if you think about the Fed, half of the market got it wrong, right? Because the size of the cut was kind of hanging in the balance. So I think the biggest outcome is the central banks are willing to ease. That's pretty clear. But they are very cautious. So even the Fed, they did the 50 basis points, the big cut, but they said very clearly that the market shouldn't expect cuts of that size going forward. The BOE also was very cautious. The Bank of Japan is going in a different direction, but they also said we'll watch the data, we'll watch the U.S. economy to see if they will really do this hike later this year. So I think that's the main message for now.
Aline, before we let you go, what are you and the team going to be watching for next week? Is there anything on the data front, on the central banking front that we should be watching to in particular?
Yeah, we'll have some data. I think the crucial one will be later on the employment report. But the market will be very sensitive, even in Europe, to PMIs for the path for the ECB, and also the central bank speeches. They are always potentially market moving, and I think the market needs more signal now.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.